Hello, and welcome back to The Rate We Hike. My name is Mike Shanley, financial advisor with Walnut Peak Financial Consulting, and today we're going to be discussing mutual funds. Whether you know it or not, mutual funds may play a role in your retirement or your retirement savings. They are a very popular investment tool. They are popular in 401ks. They are popular in 403bs. They're a popular sub-account in annuities. And so we've discussed 403bs, we discussed IRAs, we touched a little bit on 401ks, and so I thought it would be certainly fitting if it was one of the first investments, if not the first investment that we touched on. So with that, let's talk a little bit about what mutual fund is. I think the simplest explanation would be don't put all of your eggs in one basket. Investing in a stock is certainly a nice proposition, right? If you could guarantee that the stock was going to go up, or if you knew exactly when to buy and sell, if you could guarantee timing, maybe if you could control your emotion. Ultimately, you can't really do any of those things. And so if you were to own one or two or maybe a handful of stocks, a novice investor might be faced with losing a good amount of their investment. But an investor has a real chance of enjoying large returns if they also only own one investment. But we're presented with those challenges I mentioned. If you looked at a year like today and you owned, say, your favorite stocks, what if you owned Apple and Tesla and Facebook? This year is not the best example. Most stocks lost a lot. But in a given year, if you owned a couple of your favorite stocks and they lost significant portions, then you got hurt. But if you own a mutual fund and you're spread out across 25 or 30 or 80 stocks, you have a better chance of spreading your risk over multiple. And while the proposition of significant returns definitely reduces, your chances of significant losses also goes away as well. As a visual, I wanted to try to show you what it might look like. If you can't tell, I obviously made this visual myself. It's beautiful. But diversification will serve you very well moving forward in all aspects, whether you diversify your stocks, your bonds, your mutual funds, your investment accounts, your pre-tax investments versus your post-tax, like Roth IRAs, things like that. The list goes on and on. But what you're looking at here, if you can try to imagine it, would be inside you have, let's call them companies, let's call them different industries. You can picture those as banks, healthcare companies, energy companies, whatever you would like. So those are all selected inside the mutual fund. Outside you have individuals, pensions, 401k plans, couples, whatever you want to call it. They're all pooling their money together inside. So they pool their money together inside, they buy all those stocks, and then the returns, whether they're positive or negative, are shared with those investors on the outside. The fund is managed by a team of professionals, analysts, chartered financial analysts, and things of the sort. The mutual fund itself is referred to as a portfolio.
How's your portfolio? I'd say strong to quite strong.
And those people decide when to buy and sell the stocks that they've narrowed it down to. So the top stock might make up 5% of the portfolio. The bottom stock might make up 0.25% of the portfolio. They determine when to buy and sell. Their capital gains or losses are shared with the investors regardless of whether or not the investor buys or sells the mutual fund. So that's a pretty crucial piece of information for the investor to know. If you have more questions on that, please feel free to reach out. Additionally, there are fees and expenses associated with the fund. So sometimes when you buy the fund outright, there are expenses up front. Sometimes there are not. It depends on the share class. There are annual fees and expenses associated with the fund. That goes towards the portfolio management team. that goes towards the firm that manages the fund. Those are all in the prospectus. So you have access to that. They're updated constantly, so make sure you're asking for those. Now that you know a little bit about a mutual fund, what else can we learn about it? Well, what we can learn is that, for example, if you looked at the S&P 500 index, on average it returns about 10.7%. The average mutual fund investor gets about 4.25%. What can we learn from that? Well, Vanguard has done a study, and they have learned that behavior, unconscious investor behavior, things like biases and people who buy when they should sell and sell when they should buy, things like that, could contribute to possibly 1.5% annualized. So just that alone, investor behavior and things like that, could contribute to possibly losing 1.5% of what you see on the screen. And then obviously there's other things that go into that, such as their weightings in their portfolio and what they're invested in. So mutual funds also fall into many categories where maybe some investors don't necessarily know about. Investors don't necessarily go out and invest in emerging markets. They don't necessarily go out and invest in a REIT or something of this, or a real estate investment trust. So those are other areas where investors could go to get those returns. And so sometimes it could be helpful to work with a financial planner or a financial advisor. And those are things to certainly take into consideration. And then lastly, these are all things that I certainly discuss with my clients, the things that I can help my clients with. But even if you aren't looking for professional help, hopefully you gain something very quickly from this video. Be sure to click on that subscribe button. Make sure you click on the notification bell. I want you to stay up to date on the most relevant information that I'm putting out for you on Walnut Peak Financial Consulting. To stay up to date on other social media, please see the links in the description below, and I look forward to seeing you on the next video. Thank you so much. We'll talk soon.